Welcome to the Dividend Talk podcast, episode 232. A big week of earnings. Good afternoon, European DJ. I'm not going to ask you how you are. It's been a crazy week, and I'm just wondering, have you got your popcorn? We've had earnings, Donald Trump, and we have Europe coming to save the day. So we've had everything this week.
I love it. I really love it. They say investing is boring or investing for dividends, but come on, this is amazing. And I know there's a part of politics in here, but come on, this was one of those weeks that you really wanted to be tuned in to everything that's happening. Not for your portfolio, because I don't know about you, but I don't remember really buying something. I should even check that if I did. But just the fireworks. It's truly amazing. It's truly amazing. Have you, for instance, seen also UPS yesterday?
Oh, UPS, yes, I heard. They're dropping, trying to drop Amazon as their main customer, which is a ballsy move.
Well, only 50%. And I listened into the whole earnings call. And I don't know what your thoughts are, but I think actually it's really smart. So maybe for the listeners, the UPS stock price dropped about 15 to 20% on this news because they released their quarterly earnings in the annual report. But what they are effectively saying is that they are dropping 50% of the sales that they have from Amazon, and Amazon is by far the largest customer. But they called it an account of diminishing returns, and that was very interesting to hear. And honestly, I think this is good. This is very bold to do. If you know that you have little supply chain power, and that is more with your customer like Amazon, and can just squeeze you out like in the upcoming years, then your margins are just dropping and you're not benefiting from it. Yeah. So why would you stay there on the long term, right? So I think this is really important. Now, maybe what's good for you to know why they are keeping the other 50%, because this is really about package delivery and such, and having the points, and there's enough margin in there. So they're really talking about how Amazon is vertically integrated with their own shipping company, and that kind of UPS is also for a part in there, and there's no real long-term value for the company, but just the regular package parcel delivery and such is still okay for them. But yeah, the issue here is like they have very high fixed costs to generate that revenue, so it's not like you can easily drop that fixed cost. So they were very much talking about closing buildings, which they already started doing, and all these kinds of things, and try to repurpose also a little bit of that for other revenue streams. And then the funny part is what they are talking about is like, okay, let's go more into healthcare, because it's very specialized delivery, let's say, for clinical trials. But I did my DHL deep dive in there, and I really felt like the CEO has been just reading the slides from DHL's strategy day, capital markets day. Yeah, because I heard exactly the same as what they were suddenly having the hallelujah on where they should start getting higher margins, which is interesting, really interesting.
Yeah. Look, it's a ballsy move. The CEO is very, very defiant. I think he said that Amazon is their largest customer, but not their most profitable.
Exactly.
And says something along the lines of taking their destiny back into their own hands. So
I think it's good long term, and we'll have to see how it plays out in the earnings. They were not able to give any guidance on what the margins would look like, what you may kind of expect from the EPS. So they want to do that later in the quarter still. It's like with Texas Instruments, right? If you're going to invest or something like that, you need to kind of give an idea where the bottom is for people, where the floor is, and what the impact is. But they were not able to give that yet. So maybe in a few months from now. But until then, I think, yeah. I never understood that UPS did a 50% dividend hike. I really never understood it.
Yeah, it was quite significant, wasn't it? So
yeah.
Look, ballsy move, but let's see. They dropped quite a bit, 13%, I believe. And
something like that, 15%.
Yeah, and dragged FedEx a little bit down with it. So let's see what FedEx have to say. But what about let's stay with America. Let's stay with Trump. His first week in charge. This man is I don't know what he's doing, but every time I look at the news, he's ordering another or threatening another tariff. It's Mexico, Ireland, Europe, Canada, everywhere.
Yeah, he's the same like I with my kids. Yeah, if I
Nice.
say like, if you don't clean your room, you may not play computer tonight. Yeah, this kind of what he's doing. Like, if you don't do what I ask you to do, then I'll charge tariffs on you.
Yeah, and someone even in our Facebook group put in an article saying that he was threatening foreign investors an additional 20% tax on
On
top of
dividends.
on dividends. Imagine. What
Yeah,
would you do? What would you do? What would you do? Would you sell all your American companies straight away?
no, probably not. Just my journey to financial independence would take quite a bit longer.
Yeah. I mean, you talk about yield on cost. They'd be as high as Switzerland, then it'd be 35% on top of that's a dividend tax
Yeah,
right off the bat. Oh
yeah,
man.
yeah. But I think like they always say, like uh, don't take him on his words, but listen to what he says.
Yeah.
Yeah,
That's hard
yeah.
too. But what about Europe then on top of this? They are the saviors. And I
So
know
they
you had
created the whole problem that we're in Europe, that we got knocked down by regulation. Countries are simply not properly operating anymore with the, all the policies. It's not necessarily about the Green New Deal and such, right? But just generally, like the amount of policies that have been created that are just, I mean, killing companies with bureaucracy. And now Europe came with, like, if you listen to von der Leyen and such, she stood there and said, like, very much powerful talking, and we heard you, yeah, we heard the companies and everything. We need to be competitive again. So this same Parliament, EU Commission, is going to save us now by, I guess, unwinding. So they are really look at this, right? I just want to give you a flavor of how they solve problems.
okay.
Yeah, and I try to say it in an unbiased way. Yeah. So the competitive compass, it's called. Yeah, with flagship actions pillar 1.
Okay.
So they're going to have a European Innovation Act. They are going to have a European Research Area Act. They are going to have a EU Cloud and AI Development Act. They are going to have a EU Quantum Strategy and Quantum Act. They are going to have a European Biotech Act and a bioeconomy strategy. They're going to have a life science strategy. They're going to have an Advanced Materials Act, a Space Act, and a Digital Networks Act. That's just that. Flagship Actions Pillar 2. They will have an Industrial Decarbonization Accelerator Act. They will have Steel and Metal Action Plans. They will have a high-speed rail plan. They will have a Circular Economy Act. They will have an Oceans Pact. I mean, shall I just stop here?
I was quite enjoying that.
Who's going to write all these documents?
Oh man! And by the time them documents are wrote, who's going to implement any part?
Probably this is like 2030. Yeah, I mean they say about we're going to do it now and everything, but I mean unfortunately the EU is the problem, and they will have to save it because they have in their power all the regulations. So I mean it's not like citizens can just do it, because then you end up in jail by just not complying. Yeah. What I also, when I was listening to a video, what I find kind of discomforting is that she was talking about mostly that they start with banks and financial institutions. And here I always get like, who's paying who here?
Yeah.
Citizens are paying her to do the job for the citizens, right? That comes via tax. But then the solutions prioritized are usually to financial institutions, and you can just see where the lobbying is.
Yeah.
This kills me. Yeah, she should serve citizens first.
Follow the money, though. That's what they say.
Yeah, but let the citizens with great ideas, let them innovate. Yeah, put your money first there, not straight away helping financial institutions with all kinds of lending stuff and everything. I understand that is also blocking things, but I really wonder like who's influencing the most here. And all these acts and this whole kind of wake up call now, it is just because we see a very shift to right wing parties all over Europe demanding change. Trump, I think, his win there, the realization that there are no proper companies coming out of Europe anymore, seeing that we are not at all there with AI, except ASML. But let's not give that the victory lap of Europe. That's just good old Philips that spun it off like 20 years ago. Yeah, before this whole EU was creating all this mess. Yeah, it's a miracle that it survived through that. Yeah.
Yeah, maybe Trump was a wake-up call for him, but I think it's a long road ahead, and we're very exposed, I have to say, to all these. If Trump threatens these tariffs, or if he brings some of these companies back, or if he gets this global tax, Europe could be in big trouble here.
Europe is already in trouble. Let's face it.
Yeah.
I mean, I haven't looked into all these IDs in detail and such. I just have a very hard time believing that this is going to solve us. But hey, at least some people are having a wake-up call. But what I would say, if they want to really earn the trust back of citizens, it's not the way they speak. It's just that when they get paid there, that they actually go into a debate there, and not that you see just 3-4 people in the audience on important topics. But they did clock in and got their money, right? There was like 10-15 years ago, there was this documentary that there were these journalists standing in front of the elevator, and you saw people clocking in for on Friday afternoon, let's say at noon, so that they could collect the whole presents for the money related to the presents for that let's say debate. But then they were not walking inside, they were going home. Like, these kinds of things are really deteriorating the trust of European citizens, right? If they would actually just sit there, work, debate, and not beat around the bush, I think we would to some extent start building trust a little bit. But just words they are all the time doing words has led us to this point where we are now.
A long road back. But let's move on to some maybe better news and dividend announcements. Well, we'll start with the bad one, will we? We'll start with Walgreens. Walgreens Boot Alliance. They've cut their dividend completely to zero right now.
Yeah.
Not unexpected, I have to say. On the cards,
No.
they probably should have done it when they cut the dividend by 40 or 50%.
Yeah.
The last time. LVMH keeps.
Well, actually, on
on,
Walgreens, it makes me even more bullish on Agree Realty, because Joey Agree on the show with Russ from Dapper Dividends mentioned, that he saw it coming. Yeah, and he even predicts that they could go bankrupt in a few years from now. That there's a high probability for that. Yeah. I agree with him.
I've noticed people already saying that they're starting to look cheap again, and maybe this is a catalyst to buy them. But my advice is stay away. We've seen this too many times. LVMH keeps their dividend flat at €13. What do you make of that?
Well, really simple. They are very much struggling with Asia. Yeah, so the Chinese consumers, and furthermore also, their largest business by far, responsible for 75% or so of the revenues, is fashion and leather goods, and it's minus 10%. Also, wines and spirits, like what Diageo is also selling, minus 36%. So there's just a lot going on there, and we see this we see it with other alcohol stocks. Yeah, and then the Chinese consumer, and they're exposed to both. So it's nice that they keep the dividend flat. Yeah, that's what they usually do.
Yeah. We might see this with a few more French companies. I remember this trend we've seen last quarter too. But more positive news, SHEL hiked their dividend again by 4%. We'll be speaking about them later. Evolution AB hikes their dividend by 5.6%. Again, we'll speak about those two companies later. What about Sanofi? Hikes its dividend by 4.3% and is now a proud member of the buyback club.
Yeah, they are going to do another 5 billion of buybacks. Well, they had this perfect deal with Regeneron, and it's just their sales is just really nicely growing. Yeah. So well done, I would say, to Sanofi. Yeah, that's what you want to see with pipelines.
Yeah. I mean, they were dead 2 or 3 years ago, weren't they?
Exactly.
That's how fast the changes in pharma. Chevron hikes its dividend by 4.9%, kind of on par with Shell. And Axfood hikes its dividend by 3%. I know you did a deep dive on that. Was this expected or?
Kind of in line. Yeah. Kind of in line of expectations, slightly below the 5-year CAGR. But yeah. I mean, they have a few areas in the business where they just need to improve, and it's not easy. So that's simply it. But Axfood is kind of the Ahold of the North. Yeah, I would call it.
Nice, I like that. KPN has a 7% hike to 18.2 cents per share.
Yeah, that's a
Novartis,
Dutch telecom operator, by the way,
yes,
for people that
yes,
don't know it, and they have a policy of hiking the dividend by 7% in the upcoming few years. Yeah,
and they stuck to it by the looks
yeah,
of it.
exactly.
Novartis had a nice hike of 6.1%
Mm-hmm.
on the back of a nice earnings report, and AKZ, so you might pronounce that.
Akzo Nobel, they
Yeah,
make all those car paints and everything. They are keeping the dividend flat, I think, for the third or fourth year in a row. They're just struggling.
yeah, yeah. But some nice hikes. I'm expecting a couple more over the next couple of weeks as earnings accelerate. But will we start? Will we start on Evolution Gaming?
Let's do it.
Okay. Roberto has asked a question about our thoughts on Evolution. It keeps slipping further south. Did you already start accumulating more, or are you planning to do so at a certain buy zone? So let's take a look and see what we can see. Revenues were quite strong again, up 14.7% year over year. For the quarter, it was up 12.3%. So not bad with that. EBITDA was up 23%. Margins are down slightly, as we can see, which kind of impacts earnings, but earnings are still up 18%. So it's kind of a strong year for them overall, right? Their total operating revenue grew 23%. This is driven a lot by its live casino revenue. You remember we had Wolf of Harcourt Street on the episode, and he was talking about they were doing a lot of investment to this and they were expanding their networks. And because of that, there was additional costs with wages and investments and added risks that we can see later on. But it's good to see that this is actually starting to drive some growth for them. So it's up 16% year over year. And then, as I mentioned earlier, earnings per share was up 18.4%. They have announced a dividend increase from €2.65 to €2.80, which is small by their standards, but still decent enough. And also have announced a 500 million share buyback program, which I'm not actually disappointed about, considering their share price has been under a lot of pressure lately. Every time I look in the news, there's some bad news about these guys keeping their share price down. So I'm not too disappointed with that. They are still planning to open up a couple of new studios in 2025, particularly in Brazil and the Philippines. And they're continuing this live casino expansion and are hoping to have over 1,700 tables at the end of the year, which is, I think, quite impressive. Cash flow is very, very strong. They've maintained a debt-free balance sheet, and they currently have 801 million sitting in cash. And that's slightly down from last year, but it's still no debt and a lot of cash in the balance sheet is always a good sign. So the question is, why are they dropping? Why are they always under pressure? Along with the regulations risk, their revenue is actually stagnating or dropping quarter on quarter on quarter. And it was the same this quarter. A lot of it had to do with China. There was some cyber attacks that impacted their video distribution. And that's been a lot of it. And also, we're starting to see this margin decline that I've talked about earlier. Higher costs, higher wages is all putting pressure on this margin. So it's dropping down. It was 59.5%. This is net profit margin. It's now down to 56.2%. So we can see there's a lot of pressure on margins, and that's only going one way. It's only going down slightly over the last few quarters. So I think that's the main reason for the declines. But overall, it's quite strong. What I will say is that their top 5 customers are now 46% of their revenue. That's a lot. That's also an added risk in my opinion. So when you look at the revenue kind of stagnating quarter over quarter, low margin, margins declining quarter over quarter, and the added risk of a concentrated revenue stream on top of regulations, I can understand why this company is under pressure. But I don't really see anything that would make me want to sell at the moment. I'm not buying more, I must admit, but I am not selling my position either.
I'm the same here. I've got a decent size, but with this, I think it's like always this story about a falling knife. Yeah. Well, this is not a falling knife in the sense that it goes very fast, but I would like to see some more confirmation before I rather start to buy into growth again than I'm buying dollar cost averaging now, because I did already enough. Probably if I wouldn't have anything yet, I would definitely be nibbling in. this company is just effectively the largest player in the entire market. There are many bull case scenarios as well, like the states in America are opening up. They've been hiring employees upfront, expecting scale. They have to deal with this kind of the cyber attacks. What was happening as well, like Asian distributors were just copying over the live stream and then generating money on it, so they don't earn anything from that. And that's why they're also kind of under a magnifying glass. They have to figure these kinds of things out. But then when you listen to the founder and CEO, I mean, he has a lot of credit. He deserves a lot of credits, right? And I have a feeling like, these are like growth pains that they're struggling with, and they have to figure that out.
Yeah, I'd like to see margins stabilize, but I don't see that happening until Asia, until they sort out all this trouble that they're having in Asia. Asia seems to be a real pain.
I call it really a growth pains. Like the company, I think, is just maturing in this, and it comes with certain things they have to figure out.
Yeah, but I mean, I'm sounding really negative on this, but they're still a highly profitable, highly cash generating machine. So it's not as negative as I'm making it out to sound. It's just they're dropping because of the growth that they had before this was exponential, and it's starting to slow down. But yeah, good solid company. Like you, if I didn't own some, I would probably nibble into them. I have a bit of a position as well, but as soon as I start to see margins stabilizing, revenues starting to see a little bit of growth, and Asia not causing them as much trouble, I'll probably buy in a little bit more.
Yeah. Of course, this is not investment advice. People should do their own due diligence.
This is what I will do, not what anyone else should do.
No, exactly. So let me then go to SHEL, because friends Eric Made asked us last week the SHEL earnings outlook. Well, I don't think we need to talk about the earnings outlook anymore. That's known. But just like hold on to your seat, right? But this company generated a free cash flow of 39.5 billion.
Wow.
We're talking about kind of Apple numbers here.
It's crazy, isn't it?
It's unbelievable crazy. And this for the full year. In the quarter last 4, it was 8.7 billion. So it's like below the average of per quarter in 2024. But that makes sense because the oil price has been kind of going down since the start of the year, or at least flattish, right? With a slight trend down, let's say. But gas, on the other end, last year was nicely growing, at least the EU one. And if you then look at it, also integrated gas was really in the last quarter keeping the company up, right? 4.4 billion in cash flow versus 3.6 billion before. And then upstream, which is the oil, the oil pumping of the oil was 5.3 and now 4.5. So now gas and upstream are the same, which tells you that this British gas deal that they did at that time for 60 billion or something like that, that paid itself already twice back over the last 8 years. I mean, it's now lifting the company entirely there. So, I mean, that was a masterstroke by Ben van Beurden. I always felt was a bit early in the cycle, but in hindsight, oh my God, that was a really, really good deal. And it's paying dividends. Unbelievable. Yep. But what is also nice, right? In the last 2 years, they found 3 billion in cost savings. Like just generally 1.9 billion by improving the corporate in itself, let's say, and operations, and only 1.2 billion out of this from just like privatization and stopping a few things right in the portfolio. Yeah. So there was a lot of fat on the bone there that they've been able to cut while still generating solid revenue. Yeah. So I hope it was that anyone listening was not part of the fat on the bone. Of course, that would not be so nice, but generally this is I mean, this shows like really good cost control from management. Net debt ended the year at 38.8 billion. It was 43.5 at the end of 2023, although it was up again by 3.6 billion versus the third quarter. But that had to do a little bit with an accounting definition, because now they're reflecting the recognition of the LNG Canada pipeline, at least liability. Yeah, and we often say with Ahold, when people don't really know yet how to read balance sheets, they may think that the long-term debt is not so high. But then if you look at the lease liabilities, the long-term ones, you also need to account them as debt, in my opinion, right? Because you have obligations there. So when you think about it, they're also going to buy back shares again, 3.5%. So it's again 3.5 billion. So if they continue this, we're talking again about a 6 to 8% buyback yield, depending on the share price for the, I don't know, third, fourth row in a year. I mean, it's amazing. I'll try for our premium subscribers again to show a little bit like how this is evolving. Dividend hike by 4%. So, I mean, it is my largest dividend payer. So this 4% hike defines pretty much, for a large extent, also my organic dividend growth. So it will be a bit harder to reach my 6% goal, but I take it. I'm very happy that they are prioritizing buybacks right now, because that means that, let's say, their gross dividend per quarter is declining. Yeah, if the buybacks are more than the dividend hike, which is good for when we have another down cycle. They are creating enough margin. They can then just stop the buybacks or leverage up. Yeah, if for instance, at that moment in time, the interest rates would be much cheaper than the dividend yield, yeah, then leverage up a little bit, continue buying back shares. Once the cycle is over, you start paying down debt again. Yeah. So they are creating themselves a lot of tools. They want to maintain an AA balance sheet, guys. AA, remember that. That's one step below AAA. This is what we're talking about with SHEL. So even though we say like 39 billion net debt, I mean, on a cash flow of around 40 billion on a year, they could pay all their debt off in a year at the current moment in the cycle. Honestly, I would like them to maybe do that. I would like this net debt maybe to be like 20 billion. So I wouldn't mind it if they would spend the next 2-3 years to still pay down debt. But I think here it comes really around how much do you want to sleep well at night. Yeah. So I think they're striking a balance here, but I like a little bit more ExxonMobil and Chevron, how they have less net debt. Let's call it like that.
Yeah. I like the balance that they have at the moment, though. They seem to be raising dividends, buying back shares, and paying down debt in kind of a balanced way over the last few years. Before that, maybe just after they cut the dividend, they were really aggressively targeting the debt, if you remember. And they had this target to get below, I can't remember what it was. I think it was around 55.
They had to, because they were leveraging up, right? They bought British Gas, leveraging up. They had to.
So, I mean, I don't mind. Yes, I'd like to see him pay down their debt, but I think it's nicely balanced at the moment. I'm sure if they can foresee maybe some weathered storms coming into the future, they might prioritize paying down a little bit more to clean up that balance sheet. But as you said, a AA credit rating on an energy company that's producing that amount of cash flow. There's no talk about sleep well at night. I sleep like a baby owning SHEL, I have to say. One of my better picks, and probably at a time when I was new enough to it as well. So I just wish I loaded up the truck more. That's my only regret.
Yeah. Do you think now is a good price to still buy some shares?
It's hard to buy them at this, because historically this is around our top, and there's always a cycle that drops. If you get word that they'll move to the US, then for sure I would buy them hand over fist.
I don't want it, actually. I want them to buy back shares at a 6 to 8% buyback yield, not at a 3 or 4%.
Yeah.
I mean, give me the cash flow, just, I don't care about the share price.
Yeah, but there's a lot going on in the UK. If they had stayed in Amsterdam, they might be a bit more stable. But look, that's all speculation. Let's see. But
exactly.
At the moment, they can. To me, they're like the Johnson & Johnson of the energy world. That's what they're like.
Yes.
Everything is like clockwork.
True.
Yeah. So look, SHEL, as always, have done pretty well. But let's take a look at Starbucks. And usually you talk about Starbucks, but I thought I might take the reins on this time. And you know what? They've changed the CEO lately. So Brian Nickel has come in to take over from Laxman, I think the name was the last CEO. So it's pretty hard to judge him, because I think that only happened in September, and he's only trying to implement some of his new ideas. But when I look at these results, it doesn't look that great for Starbucks. So comparable store sales declined 4% and 6%. and that's both in the US and China. So sales are down, even though revenue was kind of flat. Their like-for-like sales have been quite down. There are some good news. Rewards members continue to grow 1%. That's about it. That's the only good news I could find in the whole thing. Margins are under complete pressure. Again, higher wages, which seems to be a trend in America, benefits, and then removal of non-dairy milk charges and other things have increased costs for them. So the margins are under lots of pressure. The earnings per share has dropped 23% to 69 cents. What worries me the most is that their debt to equity remains negative. So it's negative 7.4 billion, and their debt is quite high at 15.5 billion. And I know they did this to buy back shares quite aggressively. And this was probably before Nickel's time.
Yeah, definitely.
But I mean, we're in a high interest environment. There's a lot of debt in that balance sheet. Sales are declining. He has his work cut out for him, I have to say. It looks like a tough job for him.
Yeah, well, I'm not so worried about it. I mean, of course, I want to see a lot of equity in the balance sheet. Let's be clear. But I think in this case, we need to look at the interest expense here and the interest coverage, and we need to look at generally, like, if you go to net income statement, how much of debt pay down is there from the free cash flow, right? What's really happening there? So I think those are the important metrics there. But yeah, it's Kevin Johnson, right? He was in the golden age in 2020. He thought, like, let's reward shareholders, let's leverage up to the tits in the balance sheet, and let's go for it. So that's what it is about. So it's really like you're really like just needing to make sure the cash flow is nicely covering it. And I believe I haven't dove into the quarterly earnings. That's what you did, but that's I believe what was happening. So it should be good from that point of view. But it took me a while to understand this on the balance sheet, and I can now categorize the risk better. So of course you want a pristine balance sheet, and Starbucks doesn't have it. But last time I checked, I can easily cover the debt.
Yeah, they can. I just did a quick calculation. Their interest expense is about 127 million, just looking at it, and our operating income is 1.1, so it's about 8.8. So it's okay, and look, they do generate a lot of cash flow. But personally, for me, looking at that, it's just straight away.
I know.
It's off-putting, but it's hard to fault the new CEO. He's come in. Look, he's driving expansion. He's going back to their core. He's trying to do a lot of good things for them. So it's a bit early to say if he's going to be successful or not successful. But he's got a long slog.
Yeah, no, I like a lot the CEO from what I've seen, and he has done something similar with Chipotle, right? Chipotle was also having a bit struggles at the time, also with the food poison. So this really put like the business under a magnifying glass. But then he really did an amazing job how he scaled it. Now I think he sees it also right. Starbucks needs fixing in the US. Not so much in Europe. If you look at Europe, the quality of the real estate is really good. Most of them are just packed. So it's a Chinese weaker consumer, and the competition they have there with, is it Lurk's brand, something like that. And then the US, they just need to find the mojo back there. But I think he all gets it. So let it go. I mean, it's a like evolution. It's a part of my portfolio, but not something that I lie awake from, let's say like that. But it's clearly a company that has a bit more struggles than others.
Yeah. And again, you have that Chinese element as well, which...
Yeah, but I bought this. I'm always buying Starbucks at around the $70, $75. So, from that point of view, I have enough margin still, but I have also enough conviction in this brand. It's a little bit of story to Nike as well. Yeah, they made a few choices that they need to revert back from, but I think they're able to do it. It will just maybe cost a few years before they really get back to a nice swung of growth.
Yeah, but they're trading at $109 at the moment, which is not very tempting, I have to say.
No. I agree with you.
Not at these prices, but look, it's tough year for them overall, I think. So we know that was going to be the case. That's why they got rid of the last CEO. So let's see what happens this year.
Hey, but Starbucks is Starbucks, but there is one company that's like truly on fire, and I'm so amazed by it. You know which one?
Yes, I do, because I'm looking at the show notes.
Okay. What if I tell you that their largest product from a few years ago decreased their revenue by 49.1% compared to last year?
Wow.
How can this be an optimistic story?
I know. And how can you have
Yeah.
a smile on your face just after saying that?
Yeah, because the other competing products are increased by 57.7% and 46.2%. I think our listeners start to guess already what it is. If I say Humira, Skyrizi, and Rinvoq, oh my God, what's happening here? Unbelievable. So just to put things into context, Humira, once the biggest selling drug in the world, 1.7 billion. Yeah, so it's a 50% decrease. It was 3.4 billion, but now Skyrizi, 3.8 billion in a single quarter, and Rinvoq 1.8 billion in a single quarter. Unbelievable. Worldwide sales revenues are 15 billion in one quarter, an increase of 5.6% compared to the year before, which is a lot when you have declining sales of Humira. But let's also look at the oncology portfolio. So everything related to cancer, 12% increase to 1.7 billion. But also the neuroscience portfolio is now 2.5 billion, an increase of almost 20%. Yeah, mostly driven by, for instance, the Botox therapeutic net revenues, which are now 870 million. But everything is there up. It's unbelievable. And gross margin ratio of about 71%. Clearly, they're in the cash flow and net income cycle of the pipeline.
Yep.
So it's really nice to see this, right? And they had a bit of a loss, 2 cents on a GAAP basis, but this is really due to the accounting that they had to do of the recent partial intangible asset impairment charge related to emraclidine. That's what they often need to do. It's an accounting issue, but I mean, if you take that out, it's around $2.16 in earnings per share.
Mm-hmm.
And for me, it's just amazing. Like, then you have they bought Allergen at the time, right? So just to give you an example, Botox Cosmetics. So those are the lips that everyone's pumping up. Yeah, it's 3.4% decline, but then the Botox therapeutic is 13% up. Yeah, so the same kind of brand. If it's down a bit there, then they have another lever to pull. But if you just look at this company is on fire all across the place, and of course the immunology with Skyrizi and Rinvoq are really the ones that are driving it, right? Without that, the company would be in trouble. Yeah, so they will need to replace this at some point in time. Unfortunately, they don't publish the 3 financial statements now yet. You always have to wait a week for the 10Q, so I can't see if they have been paying them down debt massively, because that's always the question with them. They bought Allergen, and they went into debt also when they were the spin-off from Abbott. They were debt loaded, so this is what we want to pay attention to, right? But I mean, top line numbers, EPS, all looking really good. Now, why I think the stock is also up about, is it 10%, 8% at the moment of this recording? It's because they're increasing guidance. So they expect $12 to $12.30 in EPS for next year. Yeah, so that means that the stock is probably still trading 16, 17 PE on a forward guidance, which is really not that much for a company that's growing everywhere. Of course, you need to always take into account that also those patents at one moment in time will start to, go off patent. But we're still a few years ahead of that. But they are reaffirming its expectations for high single-digit compounded annual revenue growth. Yeah, not EPS growth, revenue growth through 2029. So for the next 4 years, it assumes 2024 as a base year. So for 5 years overall. They're also raising its long-term outlook for Skyrizi and Rinvoq revenues, combined 31 billion versus 27 billion that they were expecting, so 4 billion more. I mean, This is crazy. But also, like the aesthetics revenues, they also expect their high single-digit compounded annual revenue growth. Yeah, which is also relatively meaningful with 1.2 billion in revenues. So,
Yeah.
I mean, it's like perfect in an optimum situation. I tripled my value in this. I bought it in the between 60 and 70. It's now 180 somewhere, 190. I have no clue anymore. And I'm very, very much impressed with what this management is pulling off. I think for the last 4 or 5 years that we are talking on this podcast, we continue to be impressed. For me, it is by far probably the best managed pharmaceutical. I think Novo Nordisk as well, but they won the jackpot. Yeah, like beyond imagination by side effects, let's say. But for me, this Abbvie is just an outcome of smart acquisitions
Yes.
and really well done management.
There was a time I remember back, maybe 2020, when we were talking about these being a little bit risky because they had a lot of depth on the
And they still have.
balance sheet. They still have that, but they didn't have the growth. And there was
Exactly.
obviously the paint and cliff. Nobody knew how they would recover after that.
Yeah.
And that's why they were trading so cheaply, let's be
Yeah.
honest. But since then, they've just pulled a masterstroke. And the acquisition of Allocation has to go down as quite the opposite of the acquisition of Monsanto.
Oh, yes, yes, yes.
No, like comparing them, but it's it's very good.
And I am biased here because I have a more than 10% yield on cost on this stock.
Yeah.
Yeah. While it's currently at 3.5%. So, I mean, this one has really, really done me well. And as always, you only wished you bought more at the time.
Yeah. But at the time, I mean, buy when there's blood on the streets. Now what they're saying, it was a risk reward bet at the time. Who knew it would be so good? But
yeah, and it's the same with Bristol Myers, for instance, such a stock, right? It has potential, but it may also not, and that's just investing in big pharma.
Yeah,
but big pharma for me is much easier than biotech. If you go into those single biotech stocks, that's for me like lottery. With big pharma, you kind of need to see how they're managing their portfolio. You can use some logic, like understanding how diversified the pipeline is, follow a little bit like if they're replacing pipeline. It's easier to manage without the need always to know very deep the pharma and the biology side of it. Not saying it's easy. It's still for many people on the too hard pile. But this is for me the difference between biotech and big pharma. So with big pharma, it's really about allocation. What is the company allocating money to? Are they buying companies like Johnson & Johnson is doing? Bristol Myers, they're buying. And then you need to see if this starts to generate revenue, right? But they have time for that. You can observe it. Typically, there's not like a one-off patent cliff that disrupts the whole company straight away. Yeah. So I'm just very impressed. I'm very impressed with Abbvie. Disclosure, I'm of course long this stock, and I will continue to be long for probably the next 4 or 5 years. And let's hope that it keeps compounding dividends, because I mean the annual dividend is really really amazing. And when you think about the forward earnings and the current dividend of, is it 7-ish, 6 something?
Yeah.
We're talking about a 55% forward payout ratio. So if the revenue and let's say the earnings also increasing high single digits, you may expect the dividend to follow.
Yeah, you should. Knowing that company, you will. So
yeah, and that's probably close to this chowder rule, right? Of 3.5%. If you get like a dividend hike of 8.5%, you're meeting the chowder criteria of 12.
Yeah. You certainly are. Well done to you for buying at such a good entry point. And
well, hey, it made up for my other losses of buying. That's the good thing.
That's
when you buy a stock,
yes.
yeah. But like, let's say you invest 2,000 in Abbvie at the time, it will be 6,000 now. If you invested 2,000 in Bayer at the time, it will be 500 now. There's limited downsides to a stock. There's unlimited upside. That's the nice thing about portfolios here. You don't need, out of 10 investments, 10 winners. You can have 7 losers and three strong winners, and you will still do well. Yeah, that's really what I learned with investing, that you can afford mistakes. But what do the Warren Buffetts shine in the world? they came to such a level of sophistication that they are making many less mistakes than they maybe used to make in the beginning.
Yeah.
And that's why they have more winners and less losers. And that's really what I'm also working on.
Okay. We could have went through a lot more earnings. It's really
Yeah,
starting
we
to pick up.
didn't talk about Microsoft. We didn't talk about Apple. We
ASML.
didn't talk about ASML. Yeah, we didn't talk really deep about LVMH. But what about SAP? Cloud growth, I believe, of 30 or 25%. Unbelievable, right? I mean, we didn't talk about ADB. We didn't talk about ADP. I mean, we didn't talk about Visa. We didn't talk about Altria even, right? I mean, so much going on. ExxonMobil, Chevron, Colgate, Lyondell Basel, by the way. Dividend is again covered by free cash flow, not by a high margin, but good enough, 7% yield. So I'm happy. Novartis hiking the dividend again, like we said. Also quite good growth. So it's been a very interesting week. So much to digest. It's even hard to digest everything. So we need to be selective.
Yeah,
but I love this week. So let's let the European players also start to gear up now in the upcoming 2 weeks.
Yes, that's when it gets exciting. So, listeners' questions. And the first one is from Alexandros. What was your biggest takeaway from the meetup in Utrecht last week?
That we have an amazing community. Everyone is very curious, very open, asking questions, instead of boasting about themselves. I heard nobody boasting there. It was really like out of interest, asking questions. So for me, it was amazing. Almost 20 people there. I mean, at the time of my life. They want to do it again in Amsterdam later this year. And everyone that wants to join, I can highly recommend it. I heard a few people saying like, this is the only moment I can really talk with people about dividend growth investing. Yeah. Oftentimes you can't do it with your wife or your husband because they have a different kind of interest. Family members think like, why would I invest? Yeah. So it was really like like-minded people, and it was simply amazing.
Brilliant. Manny Mystery. My portfolio is at a point where I really should only be looking at it once every 2 weeks or even once per month. How often are you checking yours, and do you think it's too often?
Well, really checking my portfolios once a quarter when I'm doing my quarterly review with you. Of course, I check sometimes like how the portfolio is going, but do I pay attention to it? Probably not. I'm just checking like, what's my top 5 today? More often it is like to support on social media with some content, and because I'm always curious like how others are doing, like what are my top 5 most paying dividends stocks, right? So these kinds of things in absolute terms. So other than that, I don't know, maybe did I really study it once a quarter? Did I just look at it like with strong attention, maybe once a month maximum?
Yeah. Do you know what? It depends on what we're doing. Obviously, we have a podcast and we talk about our portfolios from time to time.
Yeah.
We also have a newsletter, which is on average 2 weeks,
Yeah.
where we talk about what we buy and stuff. So I find myself looking at it more so for content like that.
Exactly.
Rather than for me. I think
exactly.
if I didn't have that, it would probably just, like I had it at Trading 212, but I forgot about it. I just don't look at the accounts. But there's odd times when there's news, like when the Mag 7 Nvidia dropped 16%, I logged in to check and see how my account was down. And I was very, very surprised it went in the opposite direction.
I had the same Monday. My portfolio went up.
It's great. Like it's probably one of the biggest jumps I've had in my portfolio. It's crazy.
I always say like in those times, everyone becomes a dividend investor.
Yes. So I did check it then, but on average, how much do I really check it? Probably, when we do a quarterly review, then I'm properly checking it. Other than that, it's just glimpses.
Exactly. Same here.
We got 2 questions on politics, and I'm not surprised with what's going on. One from Jeremy and one from Jan. So how does this challenging political landscape around the globe affect your decision on investments? And Jan has more to say. He said, would you be interested in your view on how American politics start to interfere more and more into company businesses, especially when every 4 years the direction of this might change?
Yeah, I try to disconnect politics from my investment decisions. It's something I don't have influence on simply. Of course, if they would put a dividend tax of 35% on international investors in the US, yeah, then I will be more interested in Swiss stocks, yeah, maybe as well.
Yeah.
So that's how it could influence, but generally not. Generally, I don't care about it. I mean, if there's a stock that is so intertwined with the government, I generally don't tend to like them. Yeah, we saw that with Enegas as an example, right? Where I made that mistake by underestimating that. So I try to usually avoid a little bit government-controlled companies. You see this with DHL. Yeah, the German ministry has a direct seat at the board there. Yeah, probably because the post part of it is very important for they see that more as a utility. So yeah, you always need to ask yourself, do you want that interference or not?
Yeah. Yeah, it's a tough question. I'm like you. I try to keep the politics out of it, but sometimes it's hard, especially when you have a week like we've just seen, and it's just crazy, and you don't know what the outcome of that will be. And there's talks of tariffs on investments, putting businesses back from Europe into America, all sorts of things. So it's hard to say that it won't change, but at the moment it hasn't, because there's nothing set in stone. And as you said, the direction in America seems to change every 4 years depending on who's in charge and what they do. So it's hard to gauge. So stay away from the noise until there's something actually happens, and then reassess and go from there. Vladimir, are you using AI tools to analyze company finances? For example, copy pasting a PDF from the latest investor relation publication and writing a prompt to extract insights?
I tried it. I'm not satisfied. If I ask it to summarize things or something like that, it makes too many mistakes, and I cannot afford to make mistakes if I'm sharing content. Simple like that.
Yeah, we had an interesting discussion on this in the Facebook moderator chat before it came up, and there was some prompts given, and they're trying to make the prompts better, more resilient, but I'm sure that there's uses for it. But my problem is I just don't trust the result. So even if I did it, it all looks good, I have to go and check it myself anyway, and it just takes twice the time. So
yeah,
it just makes no sense. So no, I just rather just get the Excel file, populate all the figures, and have my own calculations. It's a lot safer.
But look at it from a different angle. What I did this week, I asked ChatGPT to create a shareholder letter, as if I were the CEO. Did you see it?
Yes.
Yeah, that one looked like really, really good. Yeah, it's like it was from PepsiCo. Yeah. So it looked like real, like this could have been the CEO writing it. I mean, the same kinds of blah 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 in there, and it's all going like, well, we had a great year, we will have a great year ahead, and this is it. If I wouldn't know better, and this would be copy pasted into the annual report, the shareholder letter, I would have believed that he wrote it.
Yeah, I mean,
yeah,
the AI has its uses, and there's definitely benefits. It's probably a lot to do with the prompt you give it as well, and how you extract that. But there's a lot of information in these annual reports or quarterly reports. How do you know you're going to get the right information as well?
So and the devil is in the detail, typically in the footnotes and such. So I maybe I'm not good in prompting, not good enough in prompting, but I don't trust it for analysis work. I trust it more for like some quick insights, like maybe what were like an earnings call transcript. Yeah, what are the 5 key takeaways?
Yeah, of course.
That analysts were interested in, something like that. That kind of works. But if I'm dealing with numbers and such, I really want to be precise, and for that, it's not good enough.
Yeah, but I mean, to Vladimir's point, if you're just copy pasting from a PDF and asking it to extract a table, it's probably good enough to do that.
Yeah,
so, it has. Look, it definitely has its uses. The Sambo valuations are getting crazy. Do you agree with this? And for example, he sold SAP today with a PE ratio of over 40 times earnings.
Yeah, there are few stocks where the valuation is totally crazy. I mean, can you really justify Apple at a 35 PE with 4 years of no growth? Yeah, in bottom line earnings, even though they're in cash flow and net income. I was sitting yesterday with Dividend Wave for half an hour, and we were looking into it, and you just see flat. I couldn't justify it.
Yeah.
So, but I mean, the stock market has been overvalued, in my opinion, for the last 10 years. I'm just very greedy.
Correct. Thomas has asked about Canadian banks, or more so Canadian insurance companies. He's mentioned that Canadian banks seem to be better than in other countries. And we've had lots of Canadian guests on our show, and they all beat that same drum. But what do you think of Canadian insurance companies?
I just don't know them. It's really not my circle of competence.
Yeah, I can't think of any off the top
Me
of my head.
neither. Me neither. It's really not something that pops up on my radar. Yeah. But I can imagine, like we see Europe, right? We have a few really good European insurance companies and dividend payers.
Yeah. Darshan has asked about 2 UK stocks. One of them is Grainger, ticker symbol GRI, and the other is Spectris, ticker symbol SXS. Bit of a tongue twister. So I've just briefly looked at them today when we're looking up. Grainger PLC is like a real estate investment trust. It manages and rents residential properties in the United Kingdom, and it's based in Newcastle upon Tyne. So good old Newcastle. And honestly, when I was flicking through the numbers, it just didn't appeal to me. Dividends no, I didn't go really in depth, but on the software I was using, it looked like there was 2 cuts and the numbers all look negative. So honestly, that would not really appeal to me. So I didn't spend too much time on them. However, the second one, Spectris, manufactures and sells measuring instruments and controls worldwide. And this one speaks my language. And we're talking about Omega. And I use some of these instruments to calibrate, and we measure nitrogen control, for example. So this one kind of piqued my interest a little bit. And to be honest, it kind of impressed me. Dividend yield is currently 3%. Has a long outstanding dividend history. I don't know the exact years, but looking at the graph, it's definitely over 20 years anyway. Its 5-year dividend growth rate is 5.2%. Earnings per share growth rate over the last 5 years is 45%. They have negative net debt, so their debt to equity is 0. So pretty good. Our return on invested capital is about 8.4%, which is probably typical of that industry, but it definitely interests me. So I'm going to look at this a little bit deeper, I have to say. Never heard of them before, even though I use, as I said, some of the tools. So it's definitely one that stuck out. The other one, Grainger, is not on my radar, but Spectris looks to be interesting. I don't know anything about valuation from a PE perspective. It's trading at around maybe trading 12 months, 10.9. So looks like might be a bit of value there as well. So one to look at. Anders has asked us about the utility sector, specifically Brookfield Renewables. They are out of favor right now, and in my eyes, cheap and have somewhat of a moat. They made a good deal with Microsoft in May 2024 regarding supplying their data centers with clean energy. Right now, they have a 6.9% yield and a history of raising their dividends since 2020. It's not a long time raising dividends, I have to say, but Brookfield in general are known to be well-managed, strong companies. Yeah, Brookfield, after changing with the Brookfield Corporation at the top, Brookfield Asset Management, which I have, they have the energy side and they have the infrastructure side as well. So they have 2 other companies there. And I think I prefer the infrastructure side if I remember correctly. These are into renewable energy, heavy investments, a lot of debt, but maybe not a lot of debt compared to some other utilities that I've looked at before. Their revenue growth over the last 3 years has been 12%, which is actually quite good. We know these are heavily regulated. Yeah, it's an interesting one to look at. I've been looking at one closer to home, which is Redia. this week, and I've compared them with more European-based ones. I haven't compared them with Brookfield. So it's one that a lot of people talk about, but yeah, I just don't know. Utilities are tough. They take on a lot of debt, a lot of regulation, and there's a lot of investment, particularly in this renewable cycle when you have solar, you have wind. There's a lot of investments needed. So it probably looks stronger than any of the European ones, but it's just hard at the moment.
It's a hard industry. For instance,
Yeah.
if you next year Energy, I believe, was posted on Facebook.
Yeah.
They cut their dividends, so and then you really are screwed because first of all you have capital loss plus a dividend cut. I mean, like it's a double whammy, right? That's the dangers of a dividend cut, and yeah, it's difficult one. Even Shell, I think they don't even make money on renewables, as an example.
Yeah. Now, when I look briefly, they did grow their funds from operations about 8% year over year, so they do look stronger than most of the other utilities that I have looked at. But it's just such a hard industry to be in at the moment, and I don't know what their investment cycle is or if they're heavily investing at the moment. But yeah, it's tough. But Brookfield, as I said, do quite well. I'm happy with asset management, Brookfield Asset Management. I'm happy with that side of it, and I would probably lean a little bit more into infrastructure rather than the energy one if I was looking at the Brookfield group. But look, I can see the upside. 5.6% yield. There's a bit of growth there behind that as well. Over the last 3 years, it's been 5.7%. So, yeah, I would say probably one to keep on your watch list if you're in that sector.
Yeah, nice.
Oscar, is there a stock where you would feel comfortable allocating 25% of your portfolio into at current prices or at a reasonable price?
No.
I'm not ballsy enough for that. I mean, I don't treat myself. If you're a super investor and you have all this information that the likes of Ackman has or Warren Buffett has, you might feel comfortable in that. We get our information secondhand or late, and I don't trust myself enough to have 25% of my portfolio into a single company.
It never happened to me, so it's hard to judge. Like, imagine Buffett, he buys some Apple, maybe 5-10% at a time, and then it ends up, I don't know, being 50% of your stock portfolio. Remember, he still has his own company, right? Berkshire, with all the subsidiaries. So in reality, it was probably a little bit lower. But no, not at this moment in time. No. I mean, there are stocks like for instance, if Microsoft would be trading at 200, yeah, a no-brainer. But at this price, no.
Yeah, maybe more if you had a portfolio centered around ETFs as well. It's probably a bit easier. I know some of our listeners have ETFs at its core and then spread different stocks. So that might be, I would feel more comfortable in that approach.
Yeah.
Divcraft, Ahold Delhaize have been very strong lately. Any idea why?
Yeah, you mentioned maybe the strength of the dollar. I think so. For the rest, I'll just have to wait for the annual report. In between, there was not a lot of news, so I wouldn't know. Probably just like together with the general market trend, consumer staples were bought more due to the move of money from the tech and the AI into consumer staples. So maybe that's the reason. Other than it, I really don't know.
RMS, Siemens is a great company and I'd like to own more, but it seems too expensive for their taste. What would you say is a reasonable price or PE? And have you any other European industrial suggestions?
Yeah, for me, a Siemens that's going through the cycle, I think 15 PE is a reasonable PE.
Yeah, 15, 16 is probably reasonable enough. Yeah. What about European industrials?
Don't know them. Oh, other European industrials.
Yeah.
Are there really good ones?
It's hard.
I mean, Schneider Electric is the industrial, probably. That deserves a bit of a premium. BASF, definitely not.
I mean, you have Honeywell, but that's not European.
No, ABB, that should be lower, 12, something like that. It's not the same quality.
Yeah, it's quite a tough one. I can't think of any decent ones at a decent valuation to look at right now.
And none that is comparable to Siemens in the type of business they are.
Yeah, but sure, they're diversified into everything.
No, but
David,
you have
yeah.
industrials that are maybe more into liquid gas, like Air Liquide or something like that. Yeah.
Yeah.
Or specialized gas, I mean. So, but I don't find them comparable to Siemens.
SBUX Sarco is probably one to look at there.
Maybe, yeah.
David has asked us about our discussion of ETFs back in episode 229. And we complained a lot, and we've heard a lot about this, about the lack of growing dividend, which I think a lot of people have explained to us. But there is an ETF that is available in Sweden called Exact Nordic High Dividend. It has low volume, its fees around 32%, and it's the most popular ETF in Sweden. Have you any thoughts on it?
Well, actually, first of all, I'm very thankful that we have one here, right? And I mean, if you look at the total return just in a single year, it is 18.9%. So I'm not surprised that this one is interesting for many people. I do agree it's a relatively low, how is it? A low fee. Largest holdings are Sampo, 2.75%, Trig, 2.7%, Madatum, 2.68%, Telenor. So it's really like a Nordic one. Elisa is also in there with 2.6%, Orkla, Nordea Bank. I believe they increased the dividend by 2 cents, so probably something like 1.8%.
Yeah.
So it seems to be a good one. I don't know the dividend history as such, so I would want to check that. But honestly, those are companies that I'm totally not familiar with. The dividend itself was 1.72 Swedish crowns in the last 4 quarters, 167 before. But I would need to see the entire history of distribution. So yeah, maybe it may just be such one that has a lot of potential.
Yeah, and some nice companies there. I looked at Mandatum before. I think they're asset management, but good company. So yes, I'm happy to be proven wrong. There's definitely some out there. We just are unaware of them. So thank you.
Yeah, but I haven't checked the dividend growth yet because that's what we were complaining about.
Yeah. So let's see. But always nice to know that there's a possibility that there's one out there.
Yes.
That's the thing. That's it for the end of the show. Thanks a million for all our questions as always. If you've stayed this far, please like us on Spotify, YouTube, or wherever. It really helps the algorithm, and we really appreciate it. And we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.